Today's video dives into one of the most powerful investing ideas I've come across lately. And it's coming straight from 𝗗𝗟𝗦𝗧, the legendary co-founder of Fundstrat and CIO at Fundstrat Capital. In a recent sit-down with CNBC's Dominic Chu, 𝗗𝗟𝗦𝗧 and ETF expert 𝗣𝗟𝗨𝗦 challenged the traditional idea that we're in a stock picker's market. According to Lee, that notion is outdated. We're not just picking individual names anymore, we're identifying the themes that will dominate the next decade. In his words, this is a theme picker's market, not a stock picker's one. Tom breaks down the concept of what he calls granny shots, a strategy based on finding stocks that sit at the intersection of multiple dominant themes like AI, cybersecurity, energy security, and labor shortages. And the results? Historically outperform the broader market. So here's what we're going to do. First, I'll play you a short clip from 𝗗𝗟𝗧's CNBC interview so you can hear his explanation in context. Then, I'll break it all down for you, what it means, why it matters, and how this idea is reshaping how smart investors build their portfolios. Finally, I'll take you through an in-depth analysis of the 3 best-performing stocks currently held in the GRNY ETF, which is built around Tom's own granny shot strategy. If you only watch one video today, make it this one. You'll walk away with a completely new lens on how to build long-term wealth in today's fast-changing market. Smash that like button if you're ready to rethink your investing strategy, help this video reach more people by sharing it, and be sure to subscribe so you don't miss the next big update in the markets. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. All right, let's roll the 𝗗𝗟𝗧 clip.
Maybe I'll start with you, Tom, about this idea of stock picking versus theme picking. And in this case, you are actually putting together and advising on an ETF product that goes into theme picking that then gets into stock picking. So take us through what your construct is for how to pick themes and stocks.
I would be glad to. It really has its genesis in Fundstrat's approach to research. Our clients, and we now 11 years in running, know we're a thematic-based research firm. So we do long story arcs, we look at population trends, and one of our initial white papers was the idea that there's generational trades to be made. So in the 80s, retail was a boom because women were entering the workforce. And retail stocks were the best performing subsector for 20 years, actually doing almost 160,000% return. And then in the late 90s, 2000s, the big story arc was internet, which is thematic because anybody who made money in retail would have thought the internet was a terrible idea. And so young people bought the internet story arc, and internet stocks have been amazing. And social media was the next wave. So we said, let's think about the themes that drive markets for the next 10 years. And we created a research portfolio called Granny Shots, which identified these 7 important themes. And we update that every year. But that initial theme-based portfolio was labor shortage, because in 2018 we said there was a global labor shortage coming, which equals AI. We said there'd be concerns about cybersecurity that follow that, which was another theme. Energy security was another theme we thought about, because we said, you know what, people are going to want to secure their power supplies. It's actually more important today with AI. And we looked at monetary policy, the business cycle, and then we layered in some tactical and style themes. So these were the basis for what we said, like, this is what drives investing. And then we said, okay, let's find the best stocks in each theme. But if you buy the best stocks in each theme, then you're hanging your hat on a single idea. So we said, let's be like Rick Barry. Let's do a correct physics basketball throw. Underhanded, it's the correct physics way to do it. Doesn't look sexy.
Hence the granny shots.
Correct.
That's the what, because you're talking about the underhanded free throw. Yeah.
And it doesn't look great, but it makes 90% of the shots. So we said a granny shot is one where a stock is tied to 2 themes, because now you're not sort of saying I'm putting it all into AI or all into cybersecurity. And ideally it's 3 or 4. So our granny shot says a stock to be included has to be at least in 2 themes. And we end up with 35 stocks of the S&P 500, and we're saying the other 465 are good, but these 35 are tied to the 7 most important themes driving the stock market.
All right, so this is a mix of qualitative fundamental analysis and quantitative box checking, if you will,
Correct.
things that meet certain parameters. When you think about the way, Tom, that you construct the portfolio, you're talking about under 10%, right, of the entire S&P, which is kind of like your target. You're
Yes.
even less, about 7%
Yeah.
of the S&P 500. When you look at that, how exactly do you come up with those ideas when they tick those boxes, right? What exactly do you look at in terms of the mix of qualitative and quantitative factors? And then what has that led you down towards? What types of stocks make those 7 themes ticking off at least 2 of those boxes?
Well, the 7 themes really are sort of the most important starting point, because we're like, this got to last for 7 years, and we got to figure out who the winners are. So we find and make a list of stocks tied to those themes. In other words, the strongest names for any single theme. But that is including what we call DQM. So we do a quantitative analysis. We're not buying junky stocks. We want to make sure that they generate earnings and high ROIC. But then the process of ticking off and saying, are you in 2 granny shots, is actually mechanical after that, because we have siloed portfolios of 60, 70 stocks each. And sometimes we wonder, wait, are we going to end up with like 5 granny shots? But we always end up with like 30.
All right.
And we rebalance every quarter. But it is very fortunate. And it starts to pick up some really important themes. Like when we started to think about millennials, then it had us focus on things like Robinhood. And NVIDIA, because of labor shortage, was included since 2019. And Tesla was an AI automation play at the time. So Tesla and NVIDIA are examples of, we told our clients, these are granny shots, don't think about trading them, because they're tied to really important story arcs.
All right, Dave, the idea of thematic investing is not new at all. In fact, the ETF market and ecosystem is the perfect place to talk about real-world examples of thematic investing, thematic-based ETFs. Maybe some context here from your side of things about the evolution of thematic investing. Tom has laid out kind of where the rubber meets the road as a sub-advisor for a fund, taking us through the methodology. But maybe you can provide us a little bit more of that kind of story around just how thematic investing has gotten to where it is today and where maybe the origins were.
Yeah, I mean, we started the ETF market with narrow exposures. We think about these big beta exposures that now have all the assets, but ETFs 2 through 16 were targeting small emerging markets countries, and very shortly after that, we had the select sector spiders, which was really the first place thematic investing kind of got packaged up. And those are passive, and they don't have an active manager picking and choosing sectors or themes or picking and choosing the stocks. It's just raw GICS classification. The big evolution we've seen very recently, and Tom's very much a part of it, is the move towards active management. Active management, while it's less than 10% of the assets in ETFs, is starting to look at like 30 to 40% of the flows, particularly in things like equity, where over the last 3 months, we've had 40% of the flows into active equity, into funds like Tom's. I think that's a really logical and natural expansion of what we've done in ETFs, especially as it seems like the markets are accelerating. Change happens even faster. And so I think having an active management overlay, both on the stock selection and the thematic part, can make a lot of sense for investors. It's certainly easier for investors to understand. My question to you, Tom, would be, I love your approach. I love the themes that you're in. What would it take for you to recognize that a theme is no longer valid? For instance, you have like loosening financial conditions. I'm not sure that's the word you use. That's one of your thematic sort of silos. At what point would you say, you know what, we were wrong. That theme isn't really what's going to drive markets, or this is exhausted. We've exhausted the potential revenue from this theme. We need to now come up with another bucket for those granny shots. Yes.
Well, that's where FundStrat's research team comes into play. We have about 20 research analysts, and we know there's expiration dates. I mean, think about biotech in 2016. If that was a granny shot theme that had an expiration date, we never did something with COVID or the GLP-1s. We were thinking about that. Are these 10-year story arcs, or are these 1 or 2 year? And we decided these were sort of 1 or 2 year. So to us, there is going to be expiration dates. One thing's very obvious to me is when I look at the wireless industry, I grew up as a wireless analyst, and I covered that industry for 17 years, went from 34 million users to 9 billion. So hyper growth, exponential grower. But those stocks peaked relative to the S&P 1/3 into the cycle. Every sector, infrastructure, handsets, spectrum. So it tells me that at some point, even if we say AI is going to last 20 years or cybersecurity, 1/3 into the cycle of that growth cycle, the stocks are going to become market performers. So we are really aware that relative performance is something we have to be mindful of, and that's where our technical research team is very helpful, Mark Newton, and we do something called super and sleeper granny. So we review the lists every month and think about the top 5, bottom 5, and Tireless Ken is our data scientist, and we're constantly reviewing themes. And stay tuned. We have 7 themes. Maybe we'll go to 8 themes, but we might delete a theme. And for now, I'm comfortable that energy security. These are durable themes. There is one that we're almost positive we're going to launch with, and I mean,
what's it going to be? That's your tease. You got to it begs the question. What is it?
Well, we're trying to be looking ahead 10 years, and there is something very obvious to everyone here. So I don't mind sharing it because the way we express it might be unique. Is that there's 2. The first one is what I'd call sovereign security. I think it's now evident to me that the mechanisms are in motion for companies to really fix their supply chains within a sovereign border. And that's a change, right? That's not going to just be 1 or 2 years. And so there's a lot of opportunities there. And the second thing is that, when we first started writing about these themes, this was 7 years ago. So millennials was the engine. You have to remember, 7 years ago, companies like Snapchat had to convince advertisers to focus on millennials. And now they're very mainstream. But that means we need to be focusing on Gen Z and then Gen Alpha. So we might have to evolve our demographic theme to kind of orient towards the younger cohorts. And so these are important adjustments that we're playing with, but when we turn it on, it may not be for a couple years, but I'm kind of sharing our thought process.
So first off, Tom opens the interview by addressing a question we've all been thinking about. Is the era of pure stock picking over? And his answer is yes, kind of. What's taking its place is what he calls a theme picker's market. Now, what does that actually mean? In simple terms, Tom argues that the best way to outperform over the next decade isn't by chasing individual hot stocks, but by identifying the big story arcs shaping the world, and then finding the stocks most directly tied to those stories. Think of it like this. Instead of looking for needles in a haystack, you're looking at the haystacks that matter most, and then choosing the best positioned companies within them. So what are these story arcs, or themes? According to Tom and his team at Fundstrat, they've been identifying long-term trends for more than a decade, and they've narrowed it down to 7 core themes that they believe are driving the market long-term. These include AI and the global labor shortage, cybersecurity, energy security, monetary policy shifts and the business cycle, demographic trends like millennials and Gen Z, technological innovation and digital transformation, sovereign supply chain security. Each one of these themes is something they believe will not just last for 1 or 2 years, but shape the next 7 to 10 years of market behavior. This kind of thinking is key because when you zoom out and invest in alignment with these large systemic shifts, you're not just betting on one company's quarterly report. You're betting on where the world is going. Now, let's talk about the name that caught everyone's attention, granny shots. This is Tom Lee's nickname for the strategy they're using to build this thematic ETF product. The term comes from basketball, Rick Barry's underhand free throw style, which looked awkward, but was statistically the most accurate. Same goes for this portfolio. It might not look flashy or trend-chasing, but it's built on fundamentals and long-term strategy that make it extremely high conviction. The rule? A company only gets into the granny shot portfolio if it's aligned with at least 2 of the major themes. That crossover makes it more likely to withstand short-term volatility and grow over time. So you're not just buying into AI or cybersecurity alone. You're buying into companies that sit at the intersection of multiple seismic trends. That's where the power is. Now let's talk about how Fundstrat actually picks these stocks. First, there's a qualitative layer. Their 20-plus research analysts dig into the big picture story arcs asking, is this a theme that's going to shape the economy for years, not just months? Then, there's a quantitative layer. They screen for companies that have solid earnings, strong return on invested capital, ROIC, and solid fundamentals. No junk allowed. Then comes the mechanical selection. Which companies show up in at least 2 theme portfolios? The overlap is key, because those are the companies riding multiple growth waves at once. And from there, they rebalance quarterly, constantly reviewing the top and bottom performers in what they call super granny and sleeper granny lists. Tom dropped a few names that should sound familiar if you've been following tech and growth plays. NVIDIA, tied to both AI and labor shortage themes, included in their list since 2019. Tesla, an automation and AI-driven stock, identified early on. Robinhood fits the demographic evolution from millennials to Gen Z. These aren't just momentum plays, these are stocks with multi-theme exposure and deep roots in macro trends. Here's something I really appreciated. Tom and his team know that no theme lasts forever. He gave a great example with biotech in 2016 where the hype had an expiration date. Not every theme is built to last a decade. That's why they're always reviewing performance, not just at the stock level but at the theme level. If a theme loses relevance or growth potential, it gets cut. Period. He also mentioned upcoming adjustments. For example, they may evolve the demographic theme to focus more on Gen Z and Gen Alpha rather than millennials, who've now become the mainstream consumer base. And he teased a new theme called sovereign security, driven by supply chain realignment within national borders, a trend that's accelerating thanks to geopolitics and AI compute demands. Finally, Tom and ETF expert 𝗣𝗟𝗦𝗗𝗗 talked about how active management is starting to take up more ETF market share, especially around thematic strategies. Passive still dominates overall and likely will for core portfolios, but Tom's approach is clearly aimed at the explore part of a core and explore investing strategy. That means using high-conviction, actively managed slices of your portfolio to hunt for alpha while your core stays in low-cost passive funds. It's a smart balance, and it's exactly the kind of thinking more investors are adopting as we head into a new era of market structure and technological change. So what's the big takeaway here? Tom Lee is showing us that long-term outperformance isn't about chasing the latest ticker symbol, it's about understanding the mega trends shaping the economy and owning companies that are positioned right at the center of those forces. Whether you're an active trader or a long-term investor, building part of your portfolio around durable themes, the kind that have staying power, is a strategy that makes a lot of sense right now. And if you want to go even deeper, look for the granny shot names, the ones that aren't just riding one trend but two or more. That's where the real magic happens. Let me know what you think in the comments. Are you investing thematically right now? Are any of Tom Lee's themes already part of your portfolio? And would you consider a granny shot ETF? Hit the like button if this breakdown helped clarify things for you. Subscribe for more content like this. Now let's jump right into the best 3 stocks in the Granny Shots ETF, under the ticker symbol GRNY. First up is Advanced Micro Devices, better known as AMD, a true titan in the world of semiconductors and high-performance computing. Over the past decade, AMD has transformed itself from a scrappy underdog into one of the most influential and innovative companies in the tech industry. AMD's technology powers a vast array of devices, from high-end gaming PCs that light up the dreams of gamers everywhere, to the massive data centers that form the backbone of the internet and cloud computing. Whether you're streaming your favorite show, playing the latest blockbuster game, or using AI-powered apps, there's a good chance AMD is working behind the scenes. Their Ryzen processors have completely disrupted the PC market, offering incredible performance and value that forced competitors to step up their game. Meanwhile, AMD's 𝗗𝗚𝗏 server chips have become a top choice for cloud providers and enterprises, delivering the power and efficiency needed for today's demanding workloads. AMD's exclusive partnerships with Sony PlayStation and Microsoft Xbox have secured them a steady stream of revenue regardless of the ups and downs of the traditional PC market. These deals mean that every time a new console generation launches, AMD is right at the heart of the action. In the rapidly growing field of artificial intelligence, AMD's Instinct accelerators are making significant inroads. These powerful chips are designed to handle the massive data processing needs of AI and machine learning, positioning AMD as a serious challenger in a multi-billion-dollar market that's only getting bigger. Financially, AMD's story is one of remarkable growth. Their revenue and profit margins have soared in recent years, thanks to relentless innovation, smart reinvestment in research and development, and a laser focus on delivering what customers need most. At the helm is CEO Dr. Lisa Su, whose visionary leadership has been nothing short of transformative. Under her guidance, AMD has not only caught up to its rivals but has often surpassed them, earning respect across the industry and among investors. Of course, the chip industry is not without its risks. It's a cyclical and fiercely competitive space with constant pressure from supply chain disruptions and global geopolitical tensions, but AMD's diversified product portfolio and strong relationships with manufacturing partners like TSMC help them weather these storms and stay resilient. The recent acquisition of Xilinx has opened up entirely new frontiers for AMD. With Xilinx's expertise in adaptive computing, AMD now has a foothold in fast-growing markets like 5G infrastructure, aerospace, automotive, and industrial automation, unlocking new revenue streams and expanding their influence far beyond traditional PCs and servers. Today, AMD's brand is not just recognized, it's respected and sought after. This mainstream appeal gives them pricing power, helps attract top engineering talent, and cements their place as a leader in the global tech ecosystem. Their current valuation reflects not just past performance, but also their exposure to some of the biggest growth trends in technology, cloud computing, artificial intelligence, and immersive gaming. Investors see AMD as a gateway to the future of digital innovation. The competition is intense, with giants like Intel and Nvidia constantly pushing the envelope. But AMD's agility, willingness to take risks, and focus on customer needs have allowed them to carve out a unique and defensible position in the market. AMD's ROCm software platform is another key advantage, making it easier for developers to build and optimize AI applications for AMD hardware. This not only accelerates adoption, but also fosters a vibrant ecosystem of innovation around their products. Investing in AMD means betting on the backbone of our digital world. Their chips are at the core of cloud infrastructure, AI research, and the entertainment experiences that define our era. As these sectors grow, so does AMD's opportunity. Their unwavering commitment to research and development ensures they're always pushing the boundaries of what's possible, staying ahead of the curve, and setting new standards for performance and efficiency. AMD has a market cap of $220.5 billion and posted $25.79 billion in revenue for 2024. Their net income came in at $1.64 billion, giving them earnings per share of $1.38. Now, AMD's current price is sitting around $136.11. But here's where it gets interesting. Based on fair value estimates, that price is actually 99.58% below its fair value of $271.65. Yes, almost 100% undervalued. Now the PE ratio is quite high at 98.63, which might raise eyebrows, but that could also be reflective of the market pricing and future growth, especially with AMD's deepening footprint in AI, data center chips, and custom silicon. It's clearly a long-term growth story, and investors are watching closely. In summary, AMD is a powerhouse of innovation, with diversified growth, exceptional leadership, and a proven ability to adapt and thrive in a rapidly changing industry. That's why they're a core holding in the GRNY ETF, representing the best of what the tech sector has to offer for long-term investors. If you're looking for exposure to the future of technology, whether it's AI, cloud gaming, or next-generation connectivity, AMD is a stock you simply can't afford to ignore. Their journey from a struggling underdog to a global leader is one of the most compelling and inspiring stories in the history of technology. It's a testament to the power of vision, perseverance, and relentless innovation. As AMD continues to shape the future one chip at a time, their impact on the world of technology and on our daily lives will only keep growing. Next, let's talk about PayPal, ticker PYPL, the fintech pioneer that's redefined digital payments and changed the way the world moves money. Since its founding in the late 1990s, PayPal has grown from a scrappy Silicon Valley startup into a global powerhouse, fundamentally altering how individuals and businesses transact online. PayPal connects billions of people and millions of businesses, making global commerce seamless and secure. Whether you're shopping online, sending money to family overseas, or running an e-commerce business, PayPal's platform is designed to make transactions effortless, fast, and protected. Its reach extends to nearly every corner of the globe, bridging gaps between buyers and sellers, friends and family, and even entire economies. Their two-sided network, hundreds of millions of consumers and millions of merchants, creates a powerful network effect. The more people who use PayPal, the more valuable it becomes for everyone involved. This virtuous cycle has helped PayPal become a household name, trusted by both small businesses and global brands alike. PayPal isn't just a checkout button anymore. It's a full digital wallet for payments, bills, and even crypto. Today, users can manage their finances, pay utility bills, split dinner tabs, and even buy, sell, and hold cryptocurrencies, all within the same app. This evolution has transformed PayPal into a one-stop financial hub, catering to the needs of a digital-first generation. Their brand is one of the most trusted in finance, a huge advantage in a world of online scams. Security is at the core of PayPal's offering, with advanced encryption, buyer and seller protection, and constant innovation to stay ahead of cyber threats. For many, seeing the PayPal logo at checkout is a sign of safety and peace of mind. Venmo, their peer-to-peer app, is a cultural phenomenon and a major growth opportunity as PayPal monetizes its massive user base. Venmo has become a verb in everyday conversation, especially among younger generations who use it to split bills, pay rent, and even shop online. As PayPal continues to add features and partnerships, Venmo's potential as a revenue driver only grows. Operating in over 200 markets, PayPal enables cross-border commerce and global reach. This international presence is a key differentiator, allowing users to send and receive money in multiple currencies and making it easier for businesses to expand beyond their home countries. In a world that's more connected than ever, PayPal is the bridge that brings people and businesses together. The stock has pulled back after pandemic highs, but new CEO Alex Chriss is focused on profitable growth and innovation. Under his leadership, PayPal is doubling down on efficiency, streamlining operations, and investing in new technologies to stay ahead of the competition. The company is also exploring new revenue streams, from merchant services to financial products, aiming to unlock value for shareholders. The digital payments trend is just beginning. Cash still dominates many markets, and PayPal is poised to benefit as the world goes digital. In emerging economies where access to traditional banking is limited, PayPal's mobile-first approach is opening doors for millions. As more people get online and embrace digital wallets, PayPal's addressable market continues to expand. Financially, PayPal is a cash machine with a strong balance sheet, enabling investment in growth and shareholder returns. The company generates billions in free cash flow each year, giving it the flexibility to invest in innovation, pursue strategic acquisitions, and return capital to investors through buybacks and potentially dividends in the future. Competition is fierce. Apple Pay, Google Pay, and Buy Now Pay Later services, but PayPal's platform-agnostic approach and integration of new features keep it relevant. Unlike some competitors, PayPal works across devices, operating systems, and geographies, making it a universal solution for consumers and merchants alike. Its ability to adapt and innovate is a key reason it remains a leader in the space. Their data on spending habits is a valuable asset for personalization and fraud prevention. By analyzing billions of transactions, PayPal can offer tailored experiences, detect suspicious activity, and help users manage their finances more effectively. This data-driven approach not only enhances security but also creates new opportunities for growth. Braintree, their payment processor, powers major apps like Uber and Airbnb, expanding PayPal's reach behind the scenes. This business-to-business arm allows PayPal to tap into the explosive growth of the gig economy and digital marketplaces, providing the infrastructure that keeps the modern economy running smoothly. Today, PayPal is a turnaround story. Depressed valuation, but a world-class brand and network. The market may be underestimating PayPal's potential, but with a renewed focus on execution and innovation, the company is well-positioned for a comeback. The GRNY ETF is betting on PayPal's long-term value and recovery. By including PayPal in its portfolio, the ETF is signaling confidence in the company's ability to adapt, grow, and deliver returns over time. Investing in PayPal now is a bet on digital payments, brand power, and a new leadership team. It's a wager on the continued shift away from cash, the rise of e-commerce, and the growing importance of secure, flexible payment solutions in our daily lives. Margin expansion and streamlined operations could drive significant earnings growth. As PayPal becomes more efficient and focuses on high-margin opportunities, investors could see substantial upside in the years ahead. With a market cap of $74.24 billion, PayPal is still one of the biggest names in digital payments. The company brought in $31.8 billion in revenue in 2024 and netted $4.15 billion in profit. That translates to an EPS of $4.51 and a very reasonable PE ratio of 16.69. Right now, shares are trading at about $75.29, but fair value puts the stock at $125.94. That means PayPal is trading roughly 67% below where analysts believe it should be. It's a significant discount for a company with strong cash flow, expanding international footprint, and consistent user engagement. Though admittedly, PayPal has faced stiff competition from newer fintech players. Still, this could be one of those opportunities where value investors find hidden upside. In conclusion, PayPal is a fintech leader with global reach and massive long-term opportunity. Its combination of scale, trust, and innovation makes it a cornerstone of the digital economy, with the potential to shape how we pay for decades to come. The shift to digital payments is a powerful trend, and PayPal is perfectly positioned to capitalize. As more consumers and businesses embrace digital wallets, PayPal's influence will only grow, making it a key player in the future of finance. For investors with patience, PayPal could be a rewarding addition to any portfolio. The company's resilience, adaptability, and vision for the future make it a compelling choice for those looking to benefit from the ongoing digital revolution. Don't overlook this digital payments giant. As the world continues to move online, PayPal stands ready to lead the next chapter in the evolution of money. Our final company is Oracle, ticker symbol ORCL, a true titan in the world of enterprise software databases and now a rapidly emerging force in cloud computing and artificial intelligence. Oracle's journey from a database pioneer to a global technology powerhouse is a story of relentless innovation, strategic pivots, and bold leadership. At its core, Oracle's databases are the invisible engine behind the world's largest banks, airlines, retailers, and governments. These mission-critical systems handle trillions of dollars in transactions every day, making Oracle indispensable to the global economy. This deep integration creates a sticky, recurring revenue base that few competitors can match. The company's long-standing relationships with enterprise customers mean that switching away from Oracle is not just costly, it's risky. This gives Oracle a powerful defensive moat, protecting its core business and ensuring a steady stream of revenue even in uncertain times. But the real story today is Oracle's dramatic transformation into a cloud-first company. Once seen as a legacy player, Oracle has reinvented itself, investing billions into next-generation cloud infrastructure and services. Oracle Cloud Infrastructure, or OCI, was initially met with skepticism, but today, it's winning major enterprise and AI deals, thanks to its high performance, robust security, and cost efficiency. Oracle's cloud is now trusted by some of the world's most demanding organizations, including leading AI firms and Fortune 500 companies. What sets Oracle apart is how seamlessly its cloud integrates with its own applications. For existing customers, migrating to Oracle Cloud is straightforward, minimizing disruption and risk. This unique advantage accelerates cloud adoption and deepens customer loyalty. Oracle's growing success in artificial intelligence is reshaping its image. Strategic partnerships with top AI companies and investments in AI-driven solutions are positioning Oracle as an innovator, not just a legacy provider. The company is embedding AI across its product suite, from databases to business applications, unlocking new value for customers. Oracle's Fusion and NetSuite cloud applications are experiencing rapid growth, serving businesses of all sizes across the globe. These applications are tightly integrated with Oracle's infrastructure, creating powerful synergies and driving recurring revenue. Financially, Oracle is a fortress. The company generates strong free cash flow, pays steady dividends, and aggressively buys back its own shares. This disciplined approach to capital allocation has rewarded shareholders and provided stability through market cycles. Leadership is a major strength. Founder Larry Ellison's visionary thinking and relentless drive have shaped Oracle's culture, while CEO Safra Katz's operational discipline ensures profitability and efficiency. Together, they have steered Oracle through industry upheavals and positioned it for future growth. Of course, Oracle faces risks. The cloud market is fiercely competitive, with giants like Amazon, Microsoft, and Google all vying for dominance. Economic slowdowns or reductions in IT spending could also impact growth. However, Oracle's large base of recurring revenue and mission-critical systems provides resilience that many competitors lack. The recent acquisition of Cerner, a leader in healthcare IT, opens a massive new opportunity for Oracle. By bringing cloud-based patient records and advanced analytics to hospitals and clinics, Oracle is poised to transform healthcare technology and tap into a multi-billion-dollar market. Despite its size and maturity, Oracle's valuation remains reasonable. The company offers a rare combination of stability, growth, and innovation, making it attractive for both conservative and growth-oriented investors. Oracle's inclusion in the GRNY ETF highlights its status as a growth company at a reasonable price. It's a testament to Oracle's ability to evolve, adapt, and deliver value in a rapidly changing tech landscape. Today, Oracle stands at the intersection of digital transformation, cloud migration, and the AI revolution. Its technology is powering the next wave of innovation across industries, from finance and healthcare to retail and logistics. By focusing on highly regulated industries like healthcare and finance, Oracle deepens customer loyalty and builds a competitive edge. These sectors demand reliability, security, and compliance, areas where Oracle excels. With a global footprint and decades of industry expertise, Oracle is a trusted partner for mission-critical systems worldwide. Its solutions help organizations manage complexity, drive efficiency, and stay ahead in a digital world. The narrative has shifted. Oracle is no longer just a database company. It's now recognized as a leader in cloud and AI, shaping the future of enterprise technology and setting new standards for innovation. The company now boasts a market cap of $614.18 billion and brought in $57.4 billion in revenue in 2024. They reported a healthy $12.44 billion in net income, giving them earnings per share of $4.46 and a P/E ratio of 49.09. The current stock price sits at $218.96, but the fair value estimate is $275.37. That's about 25.76% under fair value, which isn't as dramatic a discount as the others. But given Oracle's aggressive growth in AI cloud services, database solutions, and enterprise SaaS, it's still notable. The company continues to evolve well beyond its legacy software roots. With a fortress balance sheet, a relentless commitment to R&D, and a clear vision for the future, Oracle is building the next generation of enterprise technology. The company's investments in AI, cloud, and industry-specific solutions are laying the groundwork for decades of growth. For long-term investors, Oracle is more than just a tech stock. It's a key pillar of the GRNY ETF and a company that continues to prove its relevance, resilience, and potential for the future. There you have it, 3 GRNY ETF powerhouses, AMD, PayPal, and Oracle, each making waves in the tech world. Each is a leader in innovation, growth, and strategic execution, shaping the future of their industries. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. For exclusive stock tips and in-depth analysis you won't find anywhere else. Join the Stocks Galore Patreon community. Details are below in the description. Now, which of these 3 stocks are you most bullish on for the next 5 years and why? Let me know your thoughts in the comments below. Don't forget to like, subscribe, and share your thoughts with the community. Thanks for watching. See you in the next one, and happy investing.